Hi, welcome to Smart Investor. My name is Ganesh. Today, we are going to learn a new strategy. The strategy's name is nothing but what you can see is Nifty Bull Call Spread, which is high probability for high profit, high safety, limited risk, low capital, and low margin. Yes, what you read, what you heard is correct about this strategy. A traditional bull call would not give you that kind of features, but the bull call, or also called covered call, I would call, uh, will give you these kind of features. So before getting into more details, let's understand types of covered calls. What are the four types of covered calls? Standard covered call, big boy covered call, poor man's covered call, and covered call, which I'm going to discuss today, also called bull call over long-term options. I would explain first three few lines and we'll discuss actual one, fourth one. Standard covered call. It's like a long in underlying and a sell OTM call. Simple. Long in futures and sell OTM call. For example, buy in fee May future and sell May 1600 call. What are the disadvantages? This unlimited risk, because stock can go as low as zero. The sold call in that case cannot compensate the loss. MTM loss is to be supplied by the cash daily because we bought future. Big buy covered call, long in underlying and sell OTM call. Here, long in underlying means we'll hold underlying in cash and remaining thing are same, sell OTM call. For example, same, buy one lot of INFI 300 quantity and sell INFI May 1600 call, and the spot is at 1588 as of previous closing. What are disadvantages? Disadvantages remains the same, and moreover, another disadvantage is C. Required capital is very high, and it's range from 5 lakh to 10 lakh. So one, to have a hold in cash, we need to invest huge amount to have this strategy. This is a called big boy covered call. Only big people who has high capital can hold this or practice this strategy. Another one is poor man's covered call. What is it? It is buying a longer dated in the money call option and writing a shorter dated out of the money call option against it. Strictly speaking, it's a diagonal debit spread. Okay, what is that? So buy one lot Nifty May 17,000 call slightly in the money and sell one lot Nifty April 18,000 call, or sell Nifty weekly options based on the strike. So this is how poor man covered call is considered generally. Or what you can do, same month, May month itself, near to that, instead of 18,000 call, one can sell 17,500 call also. So it was spot was closed previous day at 17,172 as on 22 April 2022. This is a poor man's covered call. Why it is called poor man covered calls? Unlike previous big boy covered call, we don't need to invest that much capital, 5 lakh or 10 lakh, right? So very low capital one can invest here, like hardly within 1 lakh itself you can hold one lot. That is the advantage of this. This is why it's called poor man covered calls. What are the disadvantages? If the market steeply corrected due to any black swan event and not recovered within expiry date that we take the position, the bought call becomes worthless. Another disadvantage is lower time value. It's a hardly, it has 1 month or max 2 months. Within the time market doesn't recover, then the bought call will become worthless. What are the advantages? Yes, limited loss because we bought, and low capital, unlike other covered calls, low capital as we discussed before, and high probability for high profit if market is bullish and continue to go upside since we purchase the call. Another strategy that what we are going to discuss and explore today is bull call over long-term options. What are the disadvantages we see in the previous strategy is lower time value and market tends to go down, that bot call becomes worthless. So lower time value is a very important key point. Definition is the same, but here what we do, will go longer time period options. We don't exercise near term or next month call options. We take, means we buy Nifty December 17,000 call, which is slightly in the money, and we sell Nifty one lot 18,000 call or 19,000 call, right? Both are longer dated options, 9 months or even 12 months options. So what is the advantage? Yeah, another point is, if market is in our bot zone, we can also keep selling weekly calls, right? So I will tell you why we need to sell for OTM weekly calls also. This is a third additional step in addition to other covered calls. So this is called bull call by technically, but yeah, it's like a buying a underlying and selling a call is called a covered call. So this can also be, features are like more or less look like covered call. Okay, let's see what is the advantage of this one. Mainly disadvantage only left over is if market steeply corrected, so nobody can do anything, right? So you buy some shares or whatever call or future options, market is corrected and it's not recovered, nobody can do anything. So that is only disadvantage of this strategy. If you ignore that one, if that doesn't happen, all other points are favorable to this strategy. What is that? Limited loss. Yes, previously strategy, this is also limited loss, and the stock becomes zero, but we entered into Nifty, so Nifty never becomes zero in general, right? Low capital and a higher time value, which is earlier strategy disadvantage is lower time value. Here we are having 9 months to 12 months, so chances to become bot call worthless is very low, and a high time available to recover the market, and high probability for high profit. So you see, so all these advantages, all the 6 advantages are favorable to this strategy. This is why I said no. So high probability, high safety, high profit, a low capital, right? All the advantages are favorable to this strategy. Let's understand how it look like. So bull call or this screenshot, if you see this screenshot, right? So it's long-term option 17,000 is showing here 1,395 rupees, and the 19,000 call showing 430. Of course, 18,001 is 802. So this is the one. If you see this right side, very important to understand. So you buy Nifty 17,000 call and sell Nifty 19,000 call, which is total net debit is 48,250. So right, so one lot to acquire, to hold, we are just investing, we need only 48,250 rupees. If you see any other covered call, right, if you cash holding big boy covered call or standard covered call, all these covered calls you need to invest lakhs of money, at least 2 lakhs or above. If big boy covered call is, as we discussed, 5 lakh to 10 lakh, but here one lot you can hold position with just 48,250 rupees. It is covered call, poor man covered call to poor man covered calls, right? I can say like that, right? So one can easily hold this one, and max loss is total net debit. Time left, let's say this one for this 8 months. So why we need to sell weekly calls? That's what I'm telling. So max loss is 48,000, right? We have 8 months into per month, 4 weeks, 32 weeks, right? So what we can do within 32 weeks, every week go to the premium where 30 rupees is there. go to a premium where 30 rupees is there. You can go there and sell it. So like this, within 8 months, you can recover this so-called or expected loss. So one point of time, what happens? You completely change the strategy to become lossless strategy. If you see the screenshot, right? Let's say this is a market is spot at 17,170 or 200, right? So 17,800 call is trading at 31 or 850 is trading at 25 rupees. If you go like this and keep selling for OTM calls every week, every month, 4 weeks, you will get 120 rupees premium. Like this, sometimes volatility is high, you will get high premium. So like this, what I can do, you can earn or you can recover the expected loss from the weekly calls. If let's say if spot goes in the money, anyway you go and sell for OTM calls. If spot goes in the money, right, roll over to short-term call, weekly call, or exit the entire trade with profit. Because if market goes 800,000 points from the spot, from the time you purchase, obviously your strategy would give profit. Of course, could be a little loss in the weekly sold option. That happens very rare conditions. That is the case, yes, you can exit the strategy with profit. So these are bull call live trade I have taken. These are the 17,000 call I bought and 18 immediate next 1,000 strike, right? 18,000 I sold because this would reduce my loss, significant loss. So then as of today by closing 22nd April 2022, so it is already showing in almost 1,000 rupees profit. That's okay. Just a short-term profit and loss MTM, we don't care. I'll show you this and live one. Yeah, so this is a strategy. I am sensible. I'm showing that build new custom strategy. Let's go to December month options. I'm buying 17,000, which is 1,293, and 19,000 I'm selling call, which is at 370. Max profit here showing is 53,850. Max loss 46,000. When do you get this max loss, or when do you get this max profit? Only this is realized when you hold these options till the expiry, that is by end of the December 2022 year end. If you see POP is 40%, yeah, break even and all, ignore this, but it doesn't make much sense. And funds needed just 60,000, right? So that's all. So if before to taking the trade, you need 77,000. By the after that, you need to have at least 59,000 in hand. So I told you, right, here 19,000. Let's say if you see 18,000 call, let's say you sold 18,000. See, let's see 28,000. What was this before? If you take 19,000, max loss is 46,000. If you go down 18,000, it becomes max loss is 28,000. Of course, max loss will come down. In that case, max profit also would come down, right? But this is very interesting, right? Within 8 months, you are getting this much. So if somebody wants to be a little bit aggressive, then you can go ahead and take 90,000 calls. Somebody who doesn't want to take much risk, yes, that in that case, one can go 18,000 call. So here I told you, right? So you can add weekly call to 5th May. Let's say 5th May. Let's go to 5th May. And then in that case, you will get for OTM option. Let's say here 17,800. Yes. If you go 17,800, right? What happens? In that case, you will find 31 rupees premium of 5th May options. In this case, yeah. For now, so when you take weekly call, this pay up chart, right? Max profit and loss will be changed. So do not focus on that, because understand the strategy. If market trades 1,000 points since you purchase, in that case an underlying strategy would give you profit, and yeah, weekly call will give you some loss, but in that case you can make an adjustment, like you can exit or you can roll over to next week, whatever way, like that. Otherwise, if you hold, somebody doesn't want to take that kind of risk also, what one can do, very simple, right? This just 19,000 call sell and buy 17,000, like this. So you can have hold like this. So either of the case you can do, and you can still customize according to your risk appetite, and keep buying selling weekly calls at for OTM strikes. You receive weekly premiums. Thank you for watching. Hope you understand this strategy. And if you have any queries, please be feel free to comment in the video. We'll try to reply those queries. Please subscribe to this channel, and comment and share if you feel it is useful to your friends and you. We have Telegram group, Smart Investor. If you would like to discuss or participate in group discussions or market updates, live trades, please do join for more updates and live trades I take daily or every various topics. Thank you for watching. Bye-bye.